That's what I was going to ask you. So if we do get a bear market rally, Daryl, how do you best take advantage of that? What is the strategy?
I think you have to be probably underweight equities to your longer term strategic proposal here or allocations. But the reality is, I think on the sector side, you want to be barbelled right now between defensives on one side, energy on the other. Energy is the only thing that continues to work that has any cyclicality to it. And I think you can still stay long energy, but it's no different than what we're seeing today, leadership from healthcare, staples, utilities, and energy, right? And that probably continues. We haven't seen anything to really put in a durable bottom yet, Sarah. There's been no capitulation moment. We haven't seen the VIX spike over 40. We haven't seen a put-call ratio that exceeds 125, 130. We haven't seen volumes the level that we need to see for breadth to kind of hit that capitulation moment. And I would just say there's really strong resistance at about 3,800, 3,850 on the S&P. If that can hold, we can kind of baseline and consolidate here. If it doesn't and we breach that, you're probably down to around 3,600.
Fundamentally, Daryl, what do we have to see to look for signs that this pressure may be over, that we've seen some sort of bottom? Because a lot of people make the point that we're still early in the hiking cycle and the Fed wants to go very aggressively right now to deal with inflation, and then that's going to hurt the economy. So what do you think would correspond news-wise with capitulation, or is it just technical at this point?
Yeah, I think it's largely driven by technical. I mean, we've lowered the price earnings multiple by 4 turns from around 21.5 down to 17.5. But we think the E is still wrong in the PE ratio, right? We still think consensus street estimates are too high. From a capitulation moment, it's hard to say. You never know where those come from out of the blue. I would watch kind of a credit event. So in other words, keeping close eyes on credit spreads, credit default swaps, CDSs, liquidity metrics. Those have been really well behaved. And the VIX, you still have implied volatility above realized, which is not usually a sign that you're stressing the engine at that point. It could come from a Russia sovereign debt scare later this month as OFAC deals with the May 25th date on resetting whether those payments can be made in non-ruble or dollar metrics. It could come from a NATO scare with Sweden and Finland. Something like that could create kind of a capitulation moment to put in a more durable bottom.
Or Mike, a lot of times we hear it could come from the Fed, I don't know, getting scared, getting worried potentially about recessionary impact of some of its policies. Yeah. What are you eyeing?
Well, it could in theory. I just think that that's unlikely to come very soon. Now, we are going to hear from Jay Powell tomorrow. He's got a speaking appearance. Maybe the market is kind of idling today ahead of that. But I think what's weighing on the market psychologically is, the next 2 50 basis point hikes seem pretty well baked in. But it is interesting that the market is not saying that the short rates are going to go much beyond 3% at this point.
Daryl Cronk, we'll leave it there. Thank you very much. And Mike, we'll turn back to you now on the internals. What do you see into the close?
Yeah, very mixed, Sarah. As you might expect, the index is kind of toggling above and below the flat line all day. If you look at the New York Stock Exchange breadth, you see it basically 50-50, a little bit of an advantage to the upside volume. Crude oil, interestingly, it never really gave back a lot during the China slowdowns. Even if you didn't know what was going on in the news, if you looked at this chart, you'd say, it looks kind of bullish. It's, pretty well set up. There's higher lows all the way out. And then if you take a look at the volatility index, Daryl was just mentioning, you are seeing an easing of pressure. There is some tension release. That's a net positive for stocks. And if that can kind of bleed lower into the low 20s, it would mean that the market is on somewhat more stable footing.
And we're also seeing a weaker dollar, and we're seeing lower treasury yields. So those are easing the tensions that we have seen in the markets lately, but still pressure on equities remains. Mike, thank you.